financial system, there is no neutral ground. Every dollar you hold is either earning interest for you or costing you interest. Most people spend their lives on the wrong side of that ledger, caught in a cycle of renting money. You pay to borrow it, you pay to hold it, and you pay a penalty the moment you run out of it. Look at the government's numbers. Roughly 9% of checking accounts generate 80% of all overdraft fees. Peaking at $15 billion a year, these $35 penalties effectively subsidize the free checking accounts used by the comfortable majority. Then there is the spread. Banks pay a national average of about 0.4% to hold your savings. They turn around and lend that exact money out for credit cards or car loans at rates between 7 and 22%. This gap is the net interest margin. In this model, your deposit isn't sitting in a drawer with your name on it. It is the raw material the bank uses to generate its own high-interest profit. The system is optimized to extract wealth from those living paycheck to paycheck in order to provide seamless service to those with a surplus. Charlie Munger famously argued that the first $100,000 is a necessary hurdle. It is the most grueling stretch of accumulation, but it is the prerequisite for financial escape velocity. If you save $500 a month at a 7% return, it takes 11.5 years to reach that first six-figure milestone. This is the stretch where most people quit. Because the interest is so small in the early years, the effort of saving feels entirely disproportionate to the growth of the balance. But the physics of the climb change the moment you hit a specific threshold, $85,700. At this point, a 7% return yields roughly $6,000 a year. That means the interest your money earns while you sleep has officially out-earned your entire year of manual $500 monthly contributions. Because the capital is now doing the heavy lifting, the timeline accelerates. The journey from $100,000 to $200,000 takes only 6.5 years, nearly half the time of the first climb. Warren Buffett is the primary example of this momentum. His massive net worth is largely a result of staying in the game long enough for compounding to enter its vertical phase. If you leave that $100,000 untouched for 30 years at 7%, it grows to roughly $760,000. Your only job in that 3-decade stretch is to avoid spending it. The math creates two different realities. On one side, a debtor pays roughly $1,400 a year to rent $6,300 in credit card space. On the other, the owner of $100,000 earns $4,500 a year in passive interest. At this threshold, you stop acting as the engine pushing the car and become the person who is simply steering it. Possessing $100,000 in liquid capital is rare. While the median American family has a 6-figure net worth, most is tied up in home equity. Only about 1 in 10 households actually holds this much in accessible cash. Crossing this line changes how the bank treats you. Major institutions have tiers, like Platinum Honors, that trigger at exactly $100,000. Maintenance fees are waived, savings rates get a bump, and ATM charges are refunded. This is when a relationship manager is assigned to your account. Their role is one of corporate retention. They are there to ensure your deposits don't move to a competing institution. A cushion of this size provides a level of immunity from the surrounding debt ecosystem. You no longer have a functional need for payday loans, high-interest revolving credit, or predatory financing at the checkout counter. This lack of immediate financial pressure changes the nature of your decisions. When a surprise $1,000 expense can be paid from a cushion rather than borrowed at 22%, the need to make desperate short-term choices begins to fade. You gain the ability to wait. You can pass on a toxic job because you aren't reliant on next Friday's check, and you can walk away from a bad car loan because you have other options. The consumer finance system relies on the fact that most people cannot afford to wait. It functions like a casino, optimized for players who are stressed and running low on chips. Reaching $100,000 is how you cash out of that game. You didn't beat the house, you simply stopped playing by their rules.